Our banking system just got a really troubling warning sign, and I'm here to break it down for you. So it was announced just 2 short days ago that the Federal Reserve has injected $29.4 billion worth of liquidity into the banking system. Now, it's also important to note that this is the largest injection of money into the banking system in the past 5 years. But why is the Federal Reserve doing this, and what does it all mean? Well, we can see that the Federal Reserve quietly pumped $29.4 billion into the U.S. banking system through repos. And we can see that this significant liquidity boost comes as the financial system faces increased demand for short-term funds. And that's exactly what a repo is. It's a form of short-term borrowing for dealers in government securities. So banks are basically borrowing money short-term to shore up their finances. What's important to note is it was the end of one month and we were going into a new month. So banks had to shore up their finances because banks have balance sheet requirements. And if those requirements aren't met, they could lose their license to operate as a bank. So if banks don't have enough cash on hand in reserves, that's a very bad thing for the bank and for the people that use that bank. So to shore up their finances, they turn to this guy to inject some cash into the system. It's important to note that at the same time, financial firms also parked a considerable amount of cash on Fed books, with the reverse repo facility seeing inflows of $51.8 billion. What a reverse repo is it's the purchase of securities with the agreement to sell them at a higher price at a specific future date. But why would a bank borrow money from the Federal Reserve and then immediately turn around and put money into the Federal Reserve to hold it for them? Remember, we have a balance sheet that banks are required to report on every month. And so if the repo borrowing rate is less than the reverse repo lending rate, it's smarter to park money into the Federal Reserve and just borrow against what they already have. They're basically playing a juggling game with the interest rates to get the most possible return on investment. Now, does this mean that we should start panicking, and what exactly does it mean for you? Well, basically, to put this simply, the banking system is tight on funds. Think about it like this. People are struggling to make ends meet and pay back the debt that they have. So banks wanting to shore up their finances are saying, hey, Federal Reserve, we need to borrow some money because the money that we have outstanding isn't coming back into the system right now. So they turn to the Federal Reserve to help them out with cash in the short term because they have this balance sheet that they need to constantly monitor every single month to make sure that they're good to continue operating moving forward. So is this a good sign for banks? Well, no. Is this a horrible sign for banks? Well, also no.